Hi, I'm Chip Cummings. Welcome to this week's edition of the Mortgage Minute. Well, hello everybody. This is Chip Cummings and welcome to this week's edition of the Mortgage Minute, brought to you by Mortgage Power Network. Well, the news keeps getting better all the way around. Yeah, right. Applications are down again this week. As a matter of fact, the news shows that it's down another 9.3%, and we're lower than about 26% of last year. So the news isn't looking any better. What can you do? Well, before we get into that, let's take a look at where the numbers stand. That's right, almost 7 years since we've seen anything this low. And part of it is because not only the economy slowed down, but interest rates are uncertain. The Fed this week held the line on lowering interest rates any further, which is probably a good thing to keep inflation in check. But one thing that we've seen is that it hasn't necessarily corresponded hand in hand with a lot of the bond rates. As a result, the 30-year did drop. We actually saw an 18-point decrease to 6.39%. Average nationwide rate based upon Fannie Mae and Freddie Mac records. Freddie Mac's also reporting the 15-year came down slightly to 5.95%. The 1/1 arm also saw a decline but is still hanging up there at 7.09%. Overall, refis are accounting for 36.3% of all applications. I don't know if that's good news or bad news because most of the purchases out there are actually tied to foreclosures. Locally, we see numbers such as 62% of every property that's on the marketplace right now is tied to a foreclosure or a short sale. That starts to look pretty ugly when you look at the overall market, but real estate is local, and there are some markets that are starting to see an incline. We're looking at markets like Charlotte, markets like Denver, and some other areas that are starting to see the bottom. But other areas like Nevada, Arizona, Southern California are still getting hit hard, as those areas, Las Vegas, for example, saw a 26% decrease in values over the last year. So what are we going to do to fix this crisis? Well, the Senate bill is getting closer to passage as they voted to increase the funding now to FHA by that $300 billion that we were talking about. If you're not in the FHA market now, you're missing the boat. You need to get involved in FHA. To find out more about how you can do FHA loans profitably, make sure you go to fha-lending.com. Now, speaking of the Senate, however, this bill is all but done, and it'll also allow $8,000 credit to first-time home buyers that buy vacant properties. That's right, foreclosures. But could this have a reverse effect? One of the concerns that industry has and homeowner groups is that this will encourage lenders to actually let properties go into foreclosure, knowing that cities, states, and other governments will come in and purchase those foreclosures and give those first-time home buyers an incentive. But meanwhile, there's one city that isn't taking this lying down, and that's Philadelphia. That's right, in the Philadelphia area, Sheriff John Green has decided to take a stand and put his foot down. Foreclosures in the Philadelphia area, which normally average 300 to 400, have actually ballooned and skyrocketed to 1,000 foreclosures every single month. He's not taking this lying down, and he actually has instituted a policy where they're refusing to enforce foreclosure evictions of residents in that city. And he has the backing of City Council. What the court has done is they've actually instituted a mandatory court mediation session between homeowners and lenders in an effort to keep them in their homes. This is certainly not only raising eyebrows, but raising hopes of both residents and homeowners and lenders in the area, because actually a faster mediation and a faster solution to these problems are going to keep people in homes and actually save lenders the hazard and expense of foreclosing on these properties. So where do you need to be spending your energy and time? Well, in the niche markets. FHA, as we mentioned, is a big one. In fact, they've seen their volume double over the last 6 months and now have a huge market share in many areas of the country. Speaking of FHA, however, there are many brokers and originators out there that believe that they can originate FHA loans or counsel borrowers if they're not approved through FHA. Well, FHA came out with a very important mortgagee letter, 08-17, which clarifies the use of people who are not FHA approved. Read that real carefully if you're being sucked into one of those schemes. But FHA is a great way to target those individuals that are getting ready to get into the home ownership game or that need help from some of these problem subprime loans that are out in the marketplace. The FHA Secure program has taken off, helping another 500,000 borrowers estimated over the next 9 to 12 months. Now, what you need to do is focus on your niche market. And what I mean by that is a classic example of what I talked to one of my coaching students this week about, Greg, out in the San Francisco market. In taking a very careful look at your market and figuring out how you're going to reach them. It's not good enough to just say, I do loans. Take a look at that marketplace. In his case, what we did is we looked at his income borrowers, which were over $1 million, and decided that the best place to reach them are through country clubs, private networking groups, executive groups, economic development meetings, and then tagging those type of enterprises in order to assist us in reaching those clients. We came up with a very creative approach through using golf courses and an event campaign to reach them effectively that will generate him at least another $100,000 in commissions over the course of the next 3 months. But that's another topic. We'll cover that next time. So, until next time, this is Chip Cummings saying thank you for joining me on the Mortgage Minute. Stay tuned. We'll see you next week. I'm off on vacation, but have a good one. Until then, we're out of here.